In this video, I'm going to go through the solution to the question Lurvely Ltd. It's the modified version of the question which I previously sent a link to. So it's not the question that's in the booklet, it's a variant of that. So just to show the question, okay, so we've got the details of the balance sheet at that particular date, and obviously there's a series of notes attaching to the individual items, and we're asked to calculate the deferred tax arising on the company's balance sheet at the end of the period. So as you saw already, it's easy enough to fill in the accounting book values of pretty much everything other than non-current assets. So I'm just going to start by slotting these values in. They don't typically require any changes. So you've got your 280, 90, 80, 7200, etc. So all of those are as per the balance sheet. And then we need to deal with the non-current assets. Now, with the non-current assets, as per the question, there's a series of disallowed elements in the case of land and buildings and motor vehicles, and we need to allow for those in our calculation of accounting book value. Essentially, disallowed items represent a permanent difference, and they need to be taken out of our calculations. We cannot compute deferred tax on permanent differences. So in the case of land and buildings, the adjustment, okay, if you look at note 1, the adjustment required is going to be the amount of the initial permanent difference, 25,000, and since we haven't depreciated the buildings, the adjustment is going to be 25,000. So for buildings, 25,000, so the adjusted book value would be 275. So we need to compare that against the tax-based value of the land and buildings. Plant and machinery, there's no adjustment required. And for the motor vehicles, you saw that there was a vehicle that had a €20,000 initial difference and has now gone down by 3/4 essentially. So we're going to take €5,000 as an adjustment to the accounting book value. So the adjusted book value would be 510,000 for our tangible fixed assets. Okay, so 510,000. And tax base, for non-current assets, you take the tax written down values, so that's given in the note 1. So 415,000 represents those. For the intangible assets, mix of unamortized development costs and assets which receive capital allowances. So for the unamortized development costs, it's 0 tax base, and for the other ones, it's a tax written down value amount. So that's 105,000 as per the note. Inventory is no difference. Trade receivables, there was a calculation here, and again, we've seen this already in other questions. This is concerned with the general provision which we have to add back in arriving at the tax base value. So the tax base value will be 81,000 for the trade debtors. Specific provisions are ignored. They're essentially allowed for tax purposes and they don't have an impact therefore on our deferred tax. So that's 81,000 there. Prepaid expenses, inevitably these always provide a source of difference. So looking at the elements, we've got heating oil, pension premium and rental income, and at this stage there's nothing new here. You should be familiar with the appropriate method by which we arrive at the tax base. So heating oil allowed on an accrued basis, pensions only allowed when paid. Remember, we add back accrued pensions simply by virtue of them being accrued, so they're allowed only on a cash basis. And rental income is taxed when receivable, so it's accruals basis. So the tax base then is 6,100. So a small difference there between the accounting book value and the tax base value. Cash at bank, no issue. Trade payables, again, no issue. Accrued expenses, again, we need to look at the detail here. So we have a royalty, and we're told royalties are allowed only on a cash basis, so therefore their tax base is 0. Allowable covenant, again, it's allowable when paid, so it's allowed on a cash basis, and an insurance premium is allowed on an accruals basis, so its value will match the accounting book value. So that's €400 for those items. Okay, taxation due, no issue. Short-term loans, no issue. Deferred income, this is one of the new items I included in the modified question. So the deferred income of 4,000 consists of a government grant and licensing income. Now, government grants are in Ireland entirely exempt from tax, so they cannot give rise to a deferred tax liability. So the deferred tax, the tax base rather, must match the accounting book value. Now the licensing income, this is one that is new, we haven't seen before, and there's a very specific rule for that. It's kind of a special rule, as I've said here. I just want to show this rule. You haven't seen this in other questions. So revenue in advance, or deferred income. So if it's taxed on receipt, the tax base is equal to its carrying amount, okay, and if it's recognized for tax purposes when the goods or services are received, the tax base will be nil. Now in this instance, therefore, we're looking at a nil value because it'll be recognized in future periods and taxable therefore in future periods. So when the license for future periods comes into effect, that income will become taxable in those future periods. So it's looking at this orange one here. So the revenue is recognized for tax purposes when the goods or services are received. Okay, so in the future, when the license kicks into play, the tax bill will become apparent. So the tax base will be nil in this instance. So the tax base of deferred income is going to be 3,000. And again, I think the one to note here is the licensing income, very specific rule, which we haven't seen in previous questions. Okay, so that's a tax base there of 3,000. Provisions for liabilities. Okay, again, this was the deferred tax and the repairs are allowed under IAS 37, so there's no issue there. And the long-term loans, no issue again. So again, that gives us 932 versus 667. So then we're looking at allowing for the recognized loss. Okay, and again, this is one we saw in a previous example. So we deduct the loss at that point. You can only include a historic loss for deferred tax purposes if there's ample evidence that you're going to be able to avail of it. So in other words, if you're in a loss-making situation currently, there is no ample evidence that you'll be able to actually utilize that loss in a future period. So you wouldn't be able to recognize it in your accounts. We're now told that there is sufficient evidence to recognize the value of that loss, so we take it into account in our calculations. So that gives us then 261,400, and the value therefore is going to be 32,675. That's the desired closing balance on the deferred tax account at the end of it all. Okay, so I'm going to now switch to the ledger accounts for the question. So these are the ledger accounts for Lurvely Ltd, and you can see that there's a couple of extra ones over and above those that we've normally seen in questions previously. We've got the regular ones: deferred tax provision, corporate tax liability, corporate tax expense. We've got two new extra ones here: deferred tax asset and deferred income, and this relates to the R&D tax credit, which is something I had a slide about some time back, and I want to demonstrate the issues with the accounting for that. So I just want to show first of all the relevant note about the tax issues facing the company. So this is just an extract from the actual Word document itself. So we've got corporate tax liability account of 247, which is an over provision from the prior year, and the corporation tax charge for the year is estimated at 13,260, not yet provided in the accounts. And then some new material: the company now wishes to recognise the deferred tax value of a loss of 4,000, which we've seen in the earlier workings, which can use to reduce future gains. An R&D tax credit value of 2,000. We need to deal with that, and it can use that against the current period's tax liability in full, and a dirt credit in the sum of 20 euros. So again, we've seen dirt credits previously. So I'll start by putting in the opening balance. We have a deferred tax opening balance. We were told it was 1,000 euros, and we've a corporate tax liability opening balance of 247. Now I'll deal with the 247 first of all. This is an over provision, so we need to get rid of that, and we've seen this done in previous examples. So debit the tax liability account and credit the tax expense account with 247. I'll also deal with the 13,260. We're going to recognize a liability on profits of 13,260. So credit the liability account, okay, to create a liability, debit the tax expense account, 13,260. They wish to recognise the deferred tax value of a loss in the sum of 4,000, which you can use to reduce future gains. Okay, we've done that. An R&D tax credit valued at 2,000. I'm going to deal with this. So this just is from a slide previously, how to actually account for an R&D tax credit. So I'm using method 1 that was demonstrated in the slide. So the first step is to recognise the initial credit, debit deferred tax asset account and credit deferred income account. Okay. So recognise the initial credit. Okay, so we're going to debit the deferred tax asset account, and the credit is €2,000, and credit deferred income account €2,000. Now, as the credit is used up against liabilities, okay, we're going to use this credit in the current period's tax liability in full, so it's going to be used immediately. So we have to debit the CT liability account and credit the deferred tax asset account. So debit the CT liability account and credit the deferred tax asset account. Okay, and then in future years, as the R&D expenditure is charged for expenses, debit deferred income and credit government grants, it won't become an issue for us at this moment in time. So that won't affect the deferred income. That'll be a later year item. Okay, so okay, so getting back then to other issues, there was an issue in relation to deferred tax in the question, and I'll just show that on the screen. Okay, so the provision for deferred tax of €1,000. This is the opening balance of the deferred tax account at the start of the year. It was computed using a tax rate of 10%. Tax rate is now 12.5% for the foreseeable future. Now, this isn't something that is likely to affect companies in Ireland for indeed a very long time, as has been noted in class on a number of occasions. The Irish corporate tax rate of 12.5% is very much embedded in our taxation policy, and despite pressures from Europe and other places, the Irish government has held firm to the 12.5% rate. It is used undoubtedly as a powerful marketing tool and an incentive for companies to establish themselves here in Ireland. So the 12.5% rate isn't going to change, but in this hypothetical example, we've had a situation where a deferred tax balance was calculated using a rate of 10%, and now it's 12.5%. And what we need to do is evaluate the impact on my opening balance of this change in tax rates. So this €1,000 was calculated at 10%, and you could say, in a sense, if it had been done at the correct rate, it should have been calculated at 12.5%. So there would be a little bit extra of a provision as a result of this change in tax rates. So I'm just going to show the calculation for this. So I'm going back to my working sheet. Okay, so the impact on deferred tax caused by change in tax rates. Okay, so since the balance was 1,000 at 10%, we must have had differences worth €10,000. 10,000 at 10% gives you 1,000 of a balance. Now, if we had used 12.5%, you'd have had 10,000 by 12.5% to give you 1,250. So the impact of the change in tax rates is an extra €250. So we have an extra €250 of a liability on the deferred tax account, and we need to reflect this time round. Okay, so we're going to have to increase deferred tax, credit deferred tax with €250 and debit tax expense with €250. So going back then to my ledgers, increase deferred tax with €250 and debit tax expense with €250. So that's the impact of the change in tax rates. In Ireland, as I said, excuse me, it's highly unlikely to be an issue. It's the sort of thing in exam, particularly professional exams, may be something that you see. I wouldn't be too concerned about it in the context of the ITT exam, because it is not something that is likely to affect companies here in Ireland. That's just to demonstrate one of the rules in IAS 12 about the change in tax rates and deferred tax consequences. Okay, so we have dealt with the change in the tax rates on the deferred tax. Other things that we need to do, we need to put in the dirt credit in the sum of €20. Okay, so that's going to reduce my liability. Reduce my liability by 20. Okay, so debit the liability account by 20, and the corresponding credit would be in the income account, so your interest income would be shown gross. And that gives us a closing balance of 11,240, which is essentially 13,260 less the 2,000 R&D credit, brings you back to 11,260 less the €20 dirt credit. So 11,240 is the balance on that. On the tax expense account, okay, we need to see the movement on my deferred tax. Okay, so the desired closing balance we had figured out was 32,675. So this therefore is the movement on that account, 31,425. So I need to increase deferred tax 31,425 and then debit the tax expense account with the same number. So that then leaves us with a P&L charge of 44,688. So that'll be the figure that appears in your income statement directly after profit before tax, 44,688, and it's consisting of tax on profits and some deferred tax consequences and a minor write-off of a prior over provision. So the last bit then is the note about the tax charge. So you've got your, if I may just split the screen, so you'll need to see your tax expense account visible. Okay, so just to keep that account visible. Essentially what we're doing here is we're writing this account content in table format. So we've got a tax expense less a prior over estimate of 247. So that's the 247 coming off, 13,013. Then we've got a series of deferred tax consequences, and we need to list these individually. So we've got the deferred tax arising due to an increase in tax rates, and we've got the saving from the tax losses. Okay, again, this needs to be specifically listed. That's a negative 500, and then the 31,425, because that was net of the 500, I have to make this 31,925. These two in combination add up to 31,425, and that gives you your deferred tax of 31,675 impact. So tax charge per income statement 44,688, and that is the question solution in full.